Welcome back to Money and Banking. We're moving into Chapter 4, and in this chapter, we're going to discuss what we mean when we say the interest rate. Before we can go on with the study of money and banking and financial markets, we must understand exactly what the phrase interest rate means. In this chapter, we're going to see that there is a concept that we have which is known as the yield to maturity, that is our most accurate measure of the interest rate. We want to be able to calculate the present value of future cash flows and the yield to maturity. And we want to do so on, let's just say, 4 types of credit market instruments. We want to be able to recognize the distinctions among the yield to maturity, the current yield, the rate of return, and the rate of capital gain. Now, if you're going into finance, money and banking and the like, all of these terms are going to become very familiar to you. So try to get comfortable with them now, and as they are reiterated throughout the rest of your education, they'll become very natural to you. We want to be able to interpret the distinction between real and nominal interest rates, and we'll be looking at a very handy equation called the Fisher equation that you'll definitely want in your back pocket to help you interpret these things. So let's dive right in. Measuring interest rates. We'll need to understand that the value of a nominal sum of money at different points in time is really not comparable because, of course, the value of money in terms of its purchasing power is different in different periods of time. Having a nickel today is relatively worthless. Having a nickel in 1934 might have bought you lunch, if you will. So we want to be able to compare sums of money through time, and to do so, we're going to need to have an understanding of the present value. What is the present value? Well, a dollar paid to you 1 year from now is less valuable than a dollar paid to you today. It may seem counterintuitive, but really it's not. If you had a dollar today and you deposit it in some interest-bearing account, then that dollar 1 year from today would grow at that rate of interest, $1, and then a year from now you'd have that dollar plus some rate of growth. So we need to put this together for ourselves. To understand the importance of this notion, consider the value of a $20 million lottery. Would you prefer to have that paid out to you today, or would you prefer to have $1 million paid to you each and every year for the next 20 years? Are these two values the same? The answer is no, they are not. So let's go ahead and calculate simple present value, this equation of simple present value, and we're going to sort of mutate it a little bit and apply it to different periods of time and different financial instruments. But everything that we do for the rest of this lecture in terms of valuations of bonds, calculating rates of interest and rates of return, all of it's really hinged on this nucleus idea of the present value. So let's have I be the interest rate, and we'll take the interest rate at 10%. In 1 year, $100 growing at 10% would be $110. In 2 years, $110 growing at 10% per year. So we'd grow it the first year to 110, then we'd plug 110 in, grow it again at 10%, giving us 121, right? And these two equations, we could, of course, work through the iteration, calculate line 1, then calculate line 2 by substituting the results of line 1 into our first expression on the left-hand side of line 2. Or we could simplify this by factoring out 1 plus the interest rate at the factor of 2, our 2 periods that we're growing the funds. So the process that you went through from line 1 to line 2 is the same as the process that is encapsulated in line 3, $100 multiplied by 1 plus the interest rate carried over 2 periods of time. This slide continues to iterate this process in 3 years, and then basically states to us that we can generalize this idea for any number of years that we would want, where the number of years that we're dealing with is indicated by n. 100 multiplied by 1 multiplied by the interest rate over n equals 1 year, n equals 2 years, n equals 3 years, n equals whatever year that we would want. So this is how we're going to equate values through time. Let's interpret this just a little bit more. It is a equivalent statement, or in other words, the individual would be indifferent between receiving $100 today or receiving $110 a year from now. These are equivalent sums of money, right? Over a 2-year period, an individual is indifferent between having $100 today and having $121 delivered in 2 years. These sums are equivalent once we've factored in the rate of growth of the interest rate, right? So if I were to ask you, hey, I promise to give you $110 1 year from now, and you know that the prevailing interest rate is 10%, I'd ask you, what would you give me today in order to purchase that promise of giving you $110 a year from now? And what you would do is you would calculate the present value based off this expected future cash flow, and you would tell me, well, given that the interest rate is 10%, $110 given to me a year from now is equivalent to having $100 today. So I'll pay you $100 for that promise. When we think of it this way, we're starting to think of these present value concepts as being bonds or IOUs or promises to pay at some point in the future, and then asking the market, hey, what do you think the price of this contract is worth? What would be the price of a contract that stated, I would give you $121 2 years from now? Well, if the interest rate is 10%, then the current price of that promise would be $110. So we're learning present value, which is how you can sort of inflate nominal sums of money through time at the rate of growth of the interest rate. But we're also implicitly learning about the market price of future sums of money, or in other words, bonds. In fact, we can already at this point start to describe why the market price of some bond should equal its present value. For instance, let's take the promise to pay an individual $110 1 year from now. Prevailing interest rates are, again, 10%. If the individual said, okay, I'll give you $90 for that promise. I'll give you $90 in order to secure the promise that you'll pay me $110 a year from now. Now, I could take that $90 and put it in the bank, but I would earn less than $110, right? So, of course, I would buy that bond. And in the process, I'd say, yes, I'll give you $90 for that promise. And someone else would say, I'll give you 91, I'll give you 92, I'll give you 93, I'll give you 94. And we would be bidding up the initial price of the promise to receive $110 in the future. Again, let's take that same promise, $110 delivered 1 year from now. Prevailing interest rates are 10%. Would you pay $110 for this promise? Well, no. If I had $110 in my pocket, I wouldn't give it to an individual who is promising to give me $110 1 year from now. Why not? Because I could stick it in the bank and earn $121 1 year from now. So I wouldn't pay $110 for this promise. I wouldn't pay $109. I wouldn't pay $107, and the price of the promise would start to fall. If you've been following this logic, the price of that contract must eventually gravitate towards $100 in equilibrium. So hopefully that helps you understand a little bit how we're going to be applying present value formulas to market equilibriums of supply and demand in various bond markets, right? So that's one of the ways that we can look at it moving forward. This equation, this iteration by calculating future values out of initial sums given the interest rate, can be generalized, and that will show us a calculation for present value. Here we see our simple present value calculations. Let PV stand for today's present value. Let CF stand for some future cash flow payment. This could be a face value. This could be a dividend. This could be a coupon payment on a bond. It's simply a future cash flow that we are promised to receive. And I, of course, is the interest rate. So given any two of these variables, right, we can calculate the third one. If we know that the future cash flow is $110 and the current interest rate is 10%, assuming that we're dealing with n equals to 1 period of time, then the present value of that future cash flow will be $100. If we take the future cash flow to be $121, the interest rate at 10%, and the period of time to be n equals 2, then of course the present value is $110, and so on and so on and so forth. If we're given the present value, say it's $100, an interest rate of 10% and a period of time n equals 1, the future cash flow will be equal to $110. So any two of these variables that we have, we can solve for the third one. Supposing that we know the cash flow and the present value, as well as the number of periods of time that the promise is taking place, we can then calculate for the unknown, which would be the interest rate. And this will become our concept of yield to maturity. What is the implied interest rate that would equate the present value to the future cash flow, right? We'll get to that in just a moment, but I want you to have this simple present value equation very well accounted for in your mind. I want it to be in your back pocket. I want you to have it sort of memorized and knowing how to work with it memorized, because all of the other calculations in this chapter are simply modifications to this basic concept. This is the key one. This is a nice way to visualize sort of what we've been talking about, right? If you're promised $100 over periods of time, 1 through n, how can we compare the value of those figures? Well, we can't. $100 in time 0 is not the same as $110 a year from now. It's not the same as $100 2 years from now. It's not the same as $100 n years from now, right? In order to make these values comparable, we need to do what we call is discount them. And the way that we discount them is we use our present value formula, right? And so the actual present values that we could compare are given to you in the last line. And of course, those present values are calculated for each period of time n equals 0, 1, 2, n, right? Using our present value formula. So the 100, 100, 100, 100 are not comparable. They're just nominal sums, but our present values are comparable in real terms. In this lecture, we're going to start out by looking at 4 types of credit market instruments. We'll look at a simple loan. We'll look at a fixed payment loan. We'll look at a coupon bond, and we'll also look at a discount bond. And in doing so, we're going to be using the essence of our present value formula. Ultimately, we want to get to some understanding of what we're going to be talking about when we refer to the interest rate. And as we mentioned in the first couple slides, this is, of course, the yield to maturity. What is the yield to maturity? The yield to maturity is the interest rate that equates the present value of cash flow payments received from a debt instrument with its value today. Essentially, what we have here is we have a present value, right, the price today, and we want to find the interest rate such that that present value is equal to the price today. Another way of thinking about this is in our simple present value formula, you have PV, you have FC, the future cash flow, right? You also have N, which is the number of periods of time, but you do not have I, right? The interest rate that equates the right-hand side and the left-hand side. Our yield to maturity, right, will be that implied interest rate, if you will, that equates those two sums. Let's look at yield to maturity on a simple loan. Here we have the present value, or the amount that is borrowed at time 0, and we have the promise to pay in the future cash flow in 1 year. In this case, it'll be $110. We're dealing with a number of years n equals 1, and we're asking ourselves, what is the interest rate that equates the present value, right, with the discounted future cash flow? Now, you already know the answer to this, and that's good because then you can simply look at the way that we have structured this answer. We've plugged in our knowns. We have present value equals 100. We have the future cash flow is equal to 110, and we have n is equal to 1. The thing that we don't have is the interest rate that causes the left-hand side to be equal to the right-hand side. So we're going to need to use some basic algebra to back that out. The next few lines of math are really just doing that. It's a very straightforward process in this simple one-period loan. It becomes a bit more complicated when we start dealing with iterations of exports. In this case, the interest rate that equates the left-hand side to the right-hand side is 10%. And so we could say that in this case, the yield to maturity is 10%. For our simple loans, the simple interest rate will equal the yield to maturity. And that's a handy little thing also to put in your back pocket for simple loans. The simple interest rate equals the yield to maturity. Memorizing little relationships like that can oftentimes help you answer questions on exams or homework in a very quick fashion. Let's make it just slightly more complicated. Let's go ahead and generalize this idea to a fixed payment loan that occurs over more periods of time than n equals 1. Here, we are going to go ahead and sum all of the present values of each future payment for each of the n years that we're dealing with. Note that we can't factor out 1 plus I to the powers because the powers are all different, and so we're going to need to calculate each of these additional stages along the way. This can be done on a piece of paper if it's for a small number of n years. It can be done in Excel. There are financial calculator applications in Excel, or you might just simply have a financial calculator at your disposal. For the purposes of this class and for the purposes of your homework as well as your exams, I'll make sure that every calculation that needs to be done can be done in a simple fashion with a simple calculator and a piece of paper. So you won't have to be running, n equals very large values, if you will. This fixed payment loan should make some reasonable, formative sense to you given what we've seen before, and we can extend this simple idea to that of a coupon bond. Hopefully, similarities between the equations that you're seeing are taking root, because if they are, then you can conceptualize the financial instrument that you're dealing with and really construct out of your knowledge of present value and how it's calculated over n years some kind of functional equation to help you value that asset and or calculate yield to maturity if the need be. Our coupon bond is using the exact same strategy as what we used for our fixed payment loan. The price is the price of the coupon bond, or the present value, or the loan value. The C is the yearly couponed payment, right? This is very similar to your future cash flow, right, or your future payment, if you will. F is the face value of the bond. The bond may be worth $1,000, $2,000. That's all it is, and that will be returned to you at the end of the period of time where the bond has been loaned. So if the bond was out for 5 years, each year you would receive a coupon payment, and then at the final year you would receive your final coupon payment as well as the value of the initial bond, or the face value of the bond initially. Our price is what are people going to be willing to pay for that stream of coupon payments as well as the return of the face value of the bond. In olden days, it used to be the case that when you purchased a bond, it came with a piece of paper that said somebody owes you these various payment terms, and at the very bottom of the bond was perforated tickets, like stamps almost, and each of those perforated tickets was a redeemable coupon payment that you would then mail in, and of course you would receive money in return for that coupon payment. So for instance, a 10-year bond would be a piece of paper, legally ordaining that the borrower must pay X coupon payment as well as a face value in a maturity of 10 years. And then there would be 10 little perforated sort of stamps that you would peel off and mail in that proved that you were redeemable to this coupon payment. Once all of the coupon stamps had been removed, of course, you'd send the bond in and they'd send you the face value that was quoted on the bond. At this point, one of the things I'd like to highlight for you is something which is true in all of the equations that we've looked at. You can view this equation to see it, or you can go back to your simple present value equation to see it, which is that the price and the interest rate are negatively related, right? The interest rate is in the denominator, right, of our equation here. So as the price level goes down, that implies that the interest rate must be going up. As the interest rate goes up, that implies that the price level must be going down. Now, let's take that insight and this equation captured in our mind, move on to the next slide, which discusses some of the features of the bond. When the coupon bond is priced at its face value, so P and F are equal, right, the yield to maturity will equal the coupon rate. And the coupon rate would be the percentage of the face value that the sum C equated to. The price of a coupon bond and the yield to maturity are negatively related. The yield to maturity is greater than the coupon rate when the price of the bond is below its face value. And the yield to maturity is less than the coupon rate when the price of the bond is above its face value. Let's take these things that we need to know about the inverse relationship between price and yield to maturity, and let's look at a table that illustrates that for us. Here we're again looking at our coupon bond, the yield to maturity on a 10% coupon rate bond. So here, if you had a face value of $1,000, 10% of that would be $100, and the coupon that you'd be paid in each year would be equal to $100. Right? So yields to maturity here, we know our coupon rate, we know our face value, and we know our N is equal to 10 years. We're going to go ahead and assert that we know the price of the bond, and the price of the bond will be listed in our first column, $1,200 for the purchase of this IOU, $1,100 for the price of this coupon bond, and so on and so on and so forth. Knowing the price of the bond, we then calculate the yield to maturity to see what that yield to maturity is. If the price of the bond is $1,000, the same as its coupon rate, then of course, if the price of the bond is $1,000, the same as its face value, then our yield to maturity is 10%, which is the same as our coupon rate. Were the price of the bond less than its face value, say $900 or $800, the yield to maturity would be $1,175 or 13.81%. It would be higher than the coupon rate. And if you didn't get a great deal on this bond and you had to pay $1,100 or $1,200 for it, right? Then, of course, the price of the bond would be above the face value, and your yield to maturity, the interest rate that implies equality between the left and right-hand side of the present value calculation, would be less than our coupon rate, right? 7.13%, and as the price declined, the yield to maturity coming up a little higher, 8.84%. So price of bonds and yield to maturity are inversely related. If we wanted to drive the yield to maturity down, we would simply have to buy a lot of bonds, pushing the market price from 1,000 to 1,100 to 1,200, and that purchase of tremendous amount of bonds driving up bond prices would push yields to maturity down or push interest rates down. Conversely, right, if we couldn't sell our bonds, we were having a hard time getting rid of them, the price might fall from 1,000 to 900 to 800, meaning that, market participants are not willing to hold the risk features of this bond at yields to maturity around coupon rate. As we had a hard time selling off these bonds and continued lowering the price of these bonds, it would push up the interest rate or push up the yield to maturity. So keep in mind always that negative relationship between the price of bonds and interest rates, or the price of bonds and yield to maturity. Let's talk a little bit about discount bonds. For any 1-year discount bond, right, the yield to maturity will be calculated as follows, right? The idea behind a discount bond is that there is no coupon payment, right? You have a face value of a bond, a stated promise to pay at some point in the future, and then you have a price that you have to pay to acquire that contract. So the face value may be $1,000, and a year from now you'll be getting a $1,000 payment. Well, market supply and demand will drive the current price of that promise up and down, and the yield to maturity will be calculated as the percentage difference of the current price between the face value and what you paid, right? So the face value, what I'm receiving, minus what I paid today, divided by what I paid today, gives me my yield to maturity. The face value of the discount bond, of course, here is F. P is the current price of the discount bond, and the yield to maturity equals the increase in the price over the year, divided by the initial price. As with the coupon bond, the yield to maturity is, again, negatively related to the current bond price. As T rises, the denominator rises and the numerator falls, and of course, the interest rate declines, and vice versa. For a price decline, the denominator is going down, the numerator is going up. Of course, this is driving up interest rates. So our inverse relationship again between interest rate and prices, interest rate and prices, if you will. So we've now looked at conceptually what the interest rate or the yield to maturity would be on several slightly different sort of, financial contracts transferring money through time. Let's talk about the distinction between interest rates and rates of return. Rate of return differs from the yield to maturity because it includes the possibility that you might earn a capital gain or a capital loss in addition to the regular payments that you're receiving. Let's look at the rate of return on a one-period coupon bond. Now keep in mind, this bond will be sold to the private market prior to its coming to maturity. So we won't be receiving the face value of the bond. Whoever owns that bond after us will receive that face value if and only if they hold it to maturity, right? We're not going to hold it to maturity. We're going to sell it before that final payment arrives. So let's look at what the rate of return would be, right? The payment to the owner plus the change in value expressed as a fraction of the purchasing price. Our overall rate of return will be the coupon payment divided by the price level, which will be the current yield, plus our rate of capital gain or capital loss. If in our future period of time PT plus 1 is greater than PT, then we're going to be taking more off the market than we put in, right? We're going to be buying low and selling high. That difference between the higher sale price and the lower purchasing price of our bond will of course give us an additional return above and beyond our current yield. If, on the other hand, we buy the bond at PT and we sell it at PT plus 1, but our PT plus 1 is less than what we paid for the bond, then of course our rate of return or rate of capital gain there will be negative. If the rate of capital gain is negative, it'll be eating into our current yield. And if it dominates our current yield, we might in fact be earning losses in our overall rate of return. The rate of return from holding the bond for one period of time from time t to time t plus 1. PT being the price of the bond at time t, PT plus 1 being the price of the bond at time t plus 1. C, as you know, our coupon payment, our current yield, the coupon divided by the price level of the bond, and our capital gain already thus explained. This again will be an important concept for you as well as an important equation to keep in the back of your pocket. What are some of the distinctions between interest rates and rates of return? Well, the rate of return equals the yield to maturity, but only if the holding period equals the time to maturity, in which case there is no capital gain or capital loss. A rise in the interest rate is, as we know now, associated with a fall in bond prices, and this can result in a capital loss if, of course, the time to maturity is longer than the holding period. Now, that said, the more distant a bond's maturity, right, the longer it is out in time, a 5-year, a 8-year, a 10-year, a 30-year, right? So the more distant a bond's maturity, the greater the size of the percentage price change associated with an interest rate change. We know as interest rates rise, bond prices will fall, and that will give us a capital loss, bringing down our rate of return. Well, the longer the maturity of the bond, the greater will be the capital loss. Interest rates don't always have to be positive, as is evidenced by recent experience in Japan and several European states. The more distant a bond's maturity, the lower the rate of return that occurs as a result of a capital loss, which of course stems from future prices falling, and these of course stem from an increase in the interest rate. Now, even if the bond has a very substantial interest rate, you can still earn overall losses on the bond if you're exposed to an interest rate increase. Let's go ahead and look at some. Here we see Table 2. This is 1-year returns on different maturity 10% coupon rate bonds. Now, we're looking at a couple different maturities here. So let's go to our first column, the years to maturity. When the bond was purchased, we've got a 30-year maturity, a 20-year, a 10-year, a 5-year, a 2-year, and a 1-year, right? The initial current yield on each and every one of these, we're going to keep the same. It's 10%, 10%, 10%, 10%. The initial purchasing price of any of these differing maturity bonds will keep the same at $1,000. And now we're going to assume that the interest rate has doubled. It's gone from 10% to 20%. As that interest rate doubles, the future price of the bond declines, and we're going to have to look at the overall rate of return by looking at the initial current yield and then calculating the capital loss that is implied on our bond from bond prices falling as a result of interest rates rising. And then, of course, we're going to be able to look at our rate of capital gain. And you should be able to calculate the rate of capital gain just using columns 3 and columns 4, the overall rate of return using columns 2 and columns 5, right? Very good. So for the 30-year bond, our initial bond price was $1,000, and this thing collapsed. We had a 49.7% capital loss on this bond, which ate into our 10% current yield, leaving us with a 39.7% loss overall. Right? Let's move down to the 1 year, right? We have the current yield of 10%. The rate of capital gain or capital loss doesn't matter because we only hold it for one period. And so because our bond did not have a maturity that was exposed to interest rate risk, we cashed out basically our initial current yield, which is all that we had. For the 5-year bond, we had an initial current yield of 10%, but we saw prices fall from $1,000 down to $741. Using the future price, right, PT plus 1, minus our current price, PT, we can calculate a rate of capital loss of 25.9%. That, of course, ate into our current yield of 10%, giving us an overall loss of 15.9%. In the case of the 2-year yield to maturity, we almost broke even, but not quite. Our capital loss was not enough to dominate our current yield, and we walked away with a 1.7% overall rate of return. Let's look at those rates of return overall, right? Those are including our current yield as well as our capital gain or capital loss. And we see that as the maturity of the bond increases, the size of the rate of return gets magnificently smaller, right? So we saw a negative 39.7 loss on our 30-year bond and a 1.7 gain on our 2-year bond, right? A 30.3% loss on our 10-year bond. So given these increases in interest rates, which was uniform across all maturities, the longer maturity bonds fared less well. Maturity and the volatility of bond returns, interest rate risk. Prices and returns for long-term bonds are more volatile than those for short-term bonds. When you purchase a long-term bond, you're facing an additional risk, and that additional risk is interest rate risk. So we've got liquidity that we're parting with for a longer period of time, and that's a risk to the consumer. Less they'll expect higher rates of interest. We've also got interest rate risk associated with longer term bonds, should an interest rate be expected to rise in the future. And that, of course, will be factored into the price of these long term bonds as well. Now, keep in mind, we looked at capital losses that would occur if there was an interest rate that rose in the future. But we also have a speculative upside, right? Interest rate risk goes both ways. We could have losses if the interest rate rises, but if the interest rate falls in the future, that will push up future bond prices, leaving us to have a capital gain, if you will. This becomes somewhat scary for bond markets now because, well, interest rates are so low, so you would expect them to rise at some point in the future. Now, we haven't seen it yet, but, individuals might think that low rock bottom interest rates can't be sustained for a long time, implying, of course, that bond losses will be coming at some point in the future. There is no interest rate risk for any bond whose time to maturity matches the holding period. That has been our lecture on the interest rate and our permutations of the present value formula to different sort of financial instruments. I want to break this chapter into two parts, and so the next part of this chapter will be presented to you in your next video, and it will be all about the distinction between real and nominal interest rates. Thank you. We really only have about 3 more slides yet left, so let's just press on, shall we? The distinction between real and nominal interest rates. Nominal interest rates, they make no allowance for inflation. They're not inflation adjusted, right? They might tell you that your money's growing at 10% or 15% or what have you, but they won't tell you whether or not your wealth is growing in terms of purchasing power. If the nominal interest rate is the growth rate in the amount of nominal money that you have, we also have to subtract from that the reduction in the purchasing power of your money, which of course is inflation. The real interest rate makes this adjustment. It adjusts for changes in the price level. So more accurately, it reflects the cost of borrowing. We can think about 2 different types of interest rates here. The ex ante real interest rate, which is the nominal interest rate adjusted for expected inflation, right? We would be thinking about hypothesizing what an ex ante real interest rate would be by forming an expectation of what inflation might be in the future. Now, keep in mind, when we're buying and selling today, right, we don't know what inflation is going to be in the future. And so this ex ante real interest rate is, of course, the one that we would be calculating today. Our ex post real interest rate is adjusted for actual changes in the price level which occur in the future. So once we know what the interest rate has been, once we know what the inflation rate has been, we can figure out exactly what the real change in purchasing power of our income or wealth or, stream of money might have been. Using the Fisher equation, a very important equation to talk about this relationship between real and nominal interest rates. Let I stand for the nominal interest rate. So in everything we've been doing up until this point in this chapter, we've been calculating I, the nominal interest rate, or the nominal rate of return, if you will. Yeah? Let pi e be the expected value of the inflation rate to occur in the future. Yeah? So we have that the nominal interest rate is equal to the real interest rate plus inflation. We can think of that real interest rate as being maybe fixed by a real interest rate that individuals need to secure in order to lend funds, if you will. As inflation changes, this, of course, adjusts the nominal interest rate to make sure that that real interest rate stays stable. So if there were zero inflation and investors required a 3% real interest rate, then the nominal interest rate would be 3%. But if there were 2% inflation, then of course we would have to see investors still get that real 3% rate of real interest, and that would require that the nominal interest rate compensated for our expected inflation. In this case, our real interest rate again at 3%, inflation at 2% implies that markets will drive nominal interest rates to be equal to 5%. Now, keep this equation in, again, your back pocket, but be able to work with it. So also solve this equation not for the real interest rate, not for the nominal interest rate, but for the real interest rate. And to do that, of course, we just move IR to the left-hand side and move I to the right-hand side, such that the real interest rate is equal to the nominal interest rate minus inflation. When the real interest rate is low, there are greater incentives to borrow and fewer incentives to lend. When the real interest rate is a better indicator of the incentives that individuals need to borrow and lend, since individuals are trying to make decisions on the basis of real variables rather than nominal variables. So keep this equation very handy, if you will, right? For instance, I could ask the question, if the nominal interest rate is 10% and the expected rate of inflation is 5%, what must be the real interest rate? Of course, the answer would be 5%. So hold on to this equation. Do also know, right, that really embedded in this equation, if we make a few different assumptions, like the assumption that the real interest rate is fixed for, lenders, if you will, then we have a theory of how inflation impacts nominal interest rates, right? If the real interest rate is fixed, then any change in pi e must lead to an equivalent change in I, right? So inflation will pass through, right, straight through to the interest rate. If there's 3% inflation, the interest rate will be 3%. If there's 5% inflation, the nominal interest rate will be 5%, and so on and so forth, such that all prices in the economy tend to move together. In this case, the price of goods and services and the price of money. So it can become a theory of the relationship between inflation and the interest rate. Let's go ahead and look at Figure 1, real and nominal interest rates on 3-month Treasury bills. We're using the same maturity to make these lines comparable, 1953 to 2017. We've got our nominal rate, we've got our expected real rate, and as you should be able to tell from our previous Fisher equation, the gap between those two lines is pi e, right? So the difference between the nominal interest rate and the real interest rate is expected inflation. So any gap between the blue line and the red line is inflation, expected inflation, as it were. So we can view this graph and we can actually view not only the behavior of nominal rates and also expected real rates, but we can also view another variable, which is what were markets thinking expected inflation would be. Now, in the 70s, you can see that markets were expecting expected inflation to be quite high. But after 1980, that expected inflation came down and remained remarkably stable up until the recent crises in 2006, 2007, 2008, right? And we can see that because the gap between the lines is really, visually at least, remarkably stable, generally speaking, of course. We can look at this interesting transition into 1980 where the real interest rate rose dramatically, right? And as that real interest rate rose dramatically, it was because the central bank had taken steps to lower inflation. And so expected inflation was expected to be high, but then, of course, it dropped markedly, pushing up real interest rates and nominal interest rates and the like, right? We can also view that since our most recent crises, nominal interest rates have been held down by the Federal Reserve at close to zero. And this, given fairly low inflation expectations, has driven us to a period of negative real interest rates. If you're thinking about the real interest rate as the return to lenders, that return is moving negative. And of course, it's a period of time where borrowers, at least in terms of the cost of financing, should be quite attracted to borrowing and investing. Now, of course, other factors are important, like the fact that we've dealt with a major financial crisis, expected long recession after that, and now a global pandemic where many consumers are simply staying home and saving money for an uncertain future, right? So the landscape of profitable opportunity might not look so great for many small and medium-sized businesses. Hence, these negative real interest rates, essentially the borrower paying the lender, the lender paying the borrower to borrow, still might not have a very gigantic impact on investment because of how pessimistic the outlook may be. So this has been our sort of tutorial and an introduction to interest rates. We looked at yield to maturity. We calculated present value. In fact, what we did was value bonds throughout the early part of this lecture. And then we introduced you to the important concept of the difference between real and nominal interest rates. And we gave you a handy equation to kind of capture that relationship, which was the Fisher equation. I want to thank you for your time and your attention to this lecture. I hope that it proved valuable for you. And I'm looking forward to our next lecture. Thank you so much and have a beautiful day.